What's up, folks? It's Eric with Option Hedge, and I'm bringing you a cool strategy today. So basically, this is how it goes. Wouldn't it be great that during the last downtrend when the market totally crashed, that you know exactly how to hedge and protect your portfolio? Well, I'm going to show you a great strategy on how to do that. Let's get into it. Alrighty, so I'm going to show you how to hedge your portfolio like the pros, okay? If you're like me, I had a growth portfolio, high beta stocks, and what I have here, I have ARK. So ARK has stocks like Coinbase, Roku, Twilio, and a lot of high growth beta names, which I also have in my portfolio. So that's why ARK is something is a good ETF to use to hedge your portfolio. So let me explain the parameters and the criteria for how and when you should hedge, okay? So this strategy was adopted from Peru Saxena. You can look him up on Twitter, ex-hedge fund type guy, blah, blah, blah. Anyway, this is his criteria. He uses a medium-term EMA as his primary trend filter, and he only hedges if the price of ARK is below his medium-term EMA filter and the 5 EMA is less than the 7 EMA, okay? That is it. And let's go on. And so he says that when the 5 EMA crosses above the 7 EMA and is greater, his portfolio is no longer hedged. So he's able to participate at that point in the uptrends. He goes on to say during uptrends, when price is trading above the primary trend filter, that he ignores these 5 EMA, 7 EMA crosses and does not hedge his portfolio. And he gives an example of the bull market run and growth from April 2020 to Feb 2021. All right, so what are the different parameters that Peru uses to hedge his growth portfolio? So I'm going to go over them right now. So we're going to look at his primary trend filter is actually the 50 EMA, okay? And that is the pink line with the shaded area underneath it, okay? And then he uses the 5 and 7 EMAs, okay? So basically this is how it works. Once the stock falls under the pink 50 EMA, and then at that point that fulfills part 1 of his 2-part criteria. The other part of the criteria is the 5-day EMA, the 5 EMA has to go underneath the 7 EMA. So right here, we technically are above his primary filter, primary trend filter. We cross up below it, which fulfills criteria number 1. But as you can see, the 5-day EMA is above the blue line right there. And then it's not until right about here we get that 5-day to roll underneath the 7-day. And at this point, you would hedge your portfolio, okay? So you can think of a couple different ways to do that. You could either simply short the stock, or you could use different option strategies. Maybe a call credit spread where you're actually selling premium. You can do just a straight up put, which I actually don't like to do. I never use a straight put. Maybe I do a put debit spread or a put diagonal. A put diagonal would also be something that I would consider. Okay, and just imagine if you once this closed and fulfilled both parts of the criteria for hedging, from about, this is closed at 67 bucks, and you rode that down until the point where it is no longer valid. Right around here is where the 5 EMA crosses back up above the 7 EMA. If you rode that down, that would have been a pretty good gain, especially if you had some sort of put strategy. So so basically the way this gets invalidated is one of two things: either the stock is above the 50 EMA, okay, or like I've mentioned before, the 7 EMA is above the 5 EMA, okay. Peru likes to look at the bull market from April 2020. Let's go April 2020, 04. Let's do like 01 to basically Feb. Let's do Feb 28th, okay? So, all right, so
here you can see many times where the 5 EMA is actually above the 7 EMA. Okay, red is over the blue. But since the stock is above his primary trend, the pink zone, he would not hedge. Okay, so this is a very good way to determine whether you should be risk on versus risk off, or hedged versus not hedged.